Recently, I came across EverQuote, an insurtech company that actually saw its share price decline from its earlier peak this year of around $50 a share. Upon examining its business performance and financial figures, I see an investment opportunity, so thought I want to share it with you. As an insurtech company, EverQuote's key business activity lies in providing an online marketplace for insurance shopping, connecting consumers with insurance providers through their proprietary data and technology platform using artificial intelligence and machine learning to generate targeted matches between consumers and insurance providers and policies. The idea here is to help consumers maneuver through the limited options online and often complicated and opaque pricing, and not to mention the myriad configurations of coverage that differs from providers to providers. With EverQuote's platform, consumers can come to a single starting point for a comprehensive and cost-effective insurance shopping experience, allowing them to compare policies in one central place, thereby saving both time and energy in the process. On the other hand, the company provides insurance providers with a large volume of high-intent, pre-validated referrals that match insurers' specific requirements. And this will help these insurance carriers to drive down marketing spend within the platform by reaching a more targeted customer base. Anyway, understand that automotive is the key insurance vertical that EverQuote is focusing on right now, contributing more than 80% to its top line. But the company is increasingly stepping on the gas to grow its business in other verticals as well. Generally, I think it is quite a competitive business nowadays for such comparison websites and platforms, so it will take time for EverQuote to build a moat around its business. However, as a matter of fact, EverQuote has been actively bringing more and more insurance providers on board. This will attract more consumers to the platform, thereby generating more data. With this data, the company can improve user experience, which in turn improves conversion rates and will improve consumer satisfaction over time. The result is more quote requests, more business and advertising efficiency for its insurance carriers in the marketplace. Therefore, from here you can see that the company is working on building its competitive advantage, though I think there's still more work to be done in order to truly build a moat around its business. But so far I would say that it is moving in the right direction. So, why has EverQuote's share price been declining over the past year? Well, it seems that the market is penalizing on the company's seemingly decelerating growth rate, although they are still at double-digit levels. Take the latest second quarter 2021 results as an example. Though both top and bottom line have exceeded expectations, the guidance for the third quarter of 2021 seems to indicate a smaller year-on-year increase in variable marketing margin and also a decrease in adjusted EBITDA. Variable marketing margin is effectively the company's revenue net of advertising cost, which is a key sales and marketing expense in its business. This is an important metric for management to measure because EverQuote's key business lies in spending the marketing dollar to attract customers to its platform in exchange for a referral fee or policy sales commissions from the insurance providers. Therefore, any fall in variable marketing margin can signify the weakening or even the questionability of EverQuote's business model, especially since the company is still not profitable yet. That aside, the guidance for the full year of 2021 sees the management lowering the adjusted EBITDA forecast from $26 to $30 million previously to a lower range of $23 to $26 million instead. So I suppose that's what caused the market to react negatively in terms of its share price upon the release of the second quarter 2021 results. However, I think these are short-term road bumps that a company like EverQuote is bound to face, especially since it is still in the very early stage of establishing itself in the insurtech market. For instance, the lower guidance in adjusted EBITDA for the full year of 2021 is attributed to the management's plan to invest in more agents to drive growth in the later part of the year to prepare the open enrollment period for healthcare plans. So, with the current negative sentiment, I think there's three reasons why it presents an opportunity for us to invest in EverQuote. First, although there's some short-term lowering in guidance, we are still expecting to see a year-over-year increase of 28% in revenue to the $440 to $446 million range. Same thing for its variable marketing margin that's looking to increase 28% year-over-year to $138 to $141 million range for the full year of 2021. Also, from the chart here, you can observe that EverQuote has been executing its business very well to grow its revenue at a compounded annual growth rate of 29% over the past 5 years. Based on a study done by EverQuote, the online insurance advertising spend of North American insurance carriers and agents is estimated to grow more than 16% every year through 2024. In fact, the whole insurtech market is expected to expand at a compounded annual growth rate of 34.4% through 2027 to reach a $11.94 billion market size. So I would say that we can expect EverQuote to grow between 16% to 34.4% annually over the next few years if it continues to execute well in growing its business like it did over the past few years. At such double-digit growth rate and an enterprise value to sales figure of less than 2 currently, I think it presents an opportunity to invest in the insurtech business. Put it in another way, this year's adjusted EBITDA margin works out to be about 5.5%, but that's also because the company is investing to grow its business. In the long term, the company shouldn't have an issue to hit a 10% adjusted EBITDA margin. Anyway, as mentioned earlier, the company is still in the early stage of trying to grow its business, hence it is still operating in the red. But let's say the company is able to translate 10% of its expected midpoint revenue for the full year of 2021 to its earning. That will be equivalent to $44.3 million. At the current share price of around $34.50 or a market cap of around $700 million, this will translate to a price to earnings ratio of 15.8. Again, I understand that this is probably not the right way to value this company at this point in time, but I always like to have a rough idea of potentially how much am I paying for the earnings and growth of the company. That's probably the most fundamental question we are trying to answer, even though we could be using other metrics like EV to EBITDA to evaluate companies like EverQuote. Either way, whether it is my hypothetical PE ratio or the projected EV to EBITDA values, investing at a multiple of less than 20 for the company that is growing at double digits between 16 to 34% annually, it definitely seems like an investing opportunity to me. In fact, if we go one step further, growing at just 16% through 2024 and assuming the same 10% earnings margin and perhaps a PE of 20, then EverQuote's share price could 2x from the current level of $24 to $48. The second reason EverQuote presents an opportunity is that the company has no debt at this point in time. So, apart from a lower risk perspective, it is compelling that the company is still able to grow at 20 to 30% without any financial leverage. So this is what gives me the confidence to invest in the company's future. And finally, the third reason why EverQuote is an investment opportunity lies in the sustainability of its business model. As discussed earlier, variable marketing margin is a key metric to look at based on a company's business model. Although it does not measure overall profitability per se, it helps us to understand if whatever the company earns from its referral fees and policy sales commission is more than sufficient to cover the advertising and marketing spend to acquire new consumers. Observed from the chart here, based on the past few years' results, we can see that the variable marketing margin has been increasing from 24.2% in 2015 to 31.3% in 2020. I think this is a good sign as it shows that EverQuote's business model is sustainable or in fact improving over the years. Of course, at the end of the day, we need to see that the company is able to translate those variable marketing margin to the bottom line. But from what I see, I think it is definitely moving in the right direction. With its automotive vertical continuing to grow at double digits, EverQuote has been growing its businesses in other insurance verticals very rapidly as well. Therefore, I believe that eventually the company can take advantage of its operating leverage and grow its revenue per quote request by providing not only more personalized solutions but also leveraging its ability to cross-sell products across various insurance verticals. To sum up, I think EverQuote presents a compelling investment opportunity in the insurtech business because of its recent pullback in valuations. With the current negative sentiments and depressed share price, I think the chances of substantial multiple compression is low. On the other hand, with its track record on growth, coupled with the secular shift of insurance to online platforms, I think EverQuote is well positioned to continue to grow at double digits in the near future. Moreover, with its zero debt position, and if the company is able to continue to execute well in expanding its business and creating a stronger moat around it, it could potentially be a very powerful company in the insurtech space. Anyway, even without those speculation, EverQuote's current valuation, coupled with their healthy balance sheet and strong growth prospects, its risk-reward ratio definitely seems like an investment opportunity to me. So I'm adding some positions to my portfolio and perhaps will add more if the price corrects down further, but investors should still keep track and monitor where its business is going as the company is still in the relatively early stage of business. Let me know your thoughts on this and share with us in the comment below, and consider subscribing to the channel if you think what I share with you today is useful. In the meantime, check out the recommended videos here to continue learning so that you can make better decisions. Keep learning, and I will see you next time.